What's going on, guys? This is L&J Financial Podcast coming at you with a special edition podcast where we're strictly talking to you guys about principles of investing. In this episode, we're talking about analytical trading and value investing techniques. Julian's going to give us some insight on to reading RSI 70-30, as well as some...
Yeah, we're going to give you some of our best trading tips today. So
yeah, get ready for that. So unfortunately, there will be no top 2 picks for the next week, but you know what you will get? Knowledge, which is an investment for your future, which is bigger than any gain you'll ever get in the stock market. And that's what we're coming at with you guys today. Thank you guys so much for joining us. And first things first, we're going to talk about the difference between analytical trading and value investing and kind of where they kind of meet in the middle. First things first, value investing is going into the 10K documents, I forgot something Q. I forgot what it's called, something Q documents. It's like the quarterlies. But basically, companies, in order to be listed on the SEC, they need to release documents by the quarter and by the year to show their earnings, to show if they're losing money, if they're gaining money, where the money's been going. And if you're really into accounting, it's honestly an accountant's dream because you can really see it. But I think in order to be a value investor and someone that really wants to maintain a good portfolio for the long run, you need to treat companies as if you are the CEO, as if you are the business owner, because that's what you are as a stockholder. Obviously, there's analytical things that you can do in terms of reading charts and reading graphs. That really helps for the short run, but long run, it's simply investing in good, solid companies. I'm going to come back to you with ways that you can do that. Julian, give him the analytical rundown.
Yeah, so analytical trading is just a strategy that if you're doing a aggressive or diversified plays, it's a way of securing and making sure you enter a stock at the best entry point and leaving it at the best exit point. And then we'll go more into that on ways and more strategies on how to find the best entry point and the indicators that can tell you that.
Yeah.
And yeah, it's analytical trading is just another strategy for active investing, and it's a way to make money doing day trades, swing trades, and leaving at the best points and securing all the profit that you could.
Yeah, and obviously, stock can always run up more, and it can always fall more. But the goal is, obviously, you hear it all the time, buy low and sell high, which is like saying, eat an apple once a day, the doctor goes away. It's really generic, stupid advice, but guess what? It really is true down to the fundamental of analytical trading. It's finding a bottom, or finding when it slightly starts going up. Julian will talk about that, and yeah, that's the differences between the analytical trading and value investing. Of course, if you guys have any questions, comments, or concerns about these things, always shoot us a DM at the Lucas Roll on Instagram.
And Julian McHale, same thing. Any questions?
Exactly.
Just let us know.
Hit us up, and we'll give you guys as much information as we possibly can to help you guys so you can reach your financial dreams. First things first, Julian, give them the rundown on analytical trading. What's a technique you want to teach them today?
Yeah, so the one technique I think is the best technique to use and is one that's probably the most used often in the stock market is something called the relative strength index, also known as the RSI. So this basically is an indicator that is on every platform that you can trade on, and there's 2 bars on the 70 at the top and 30 at the bottom. And you can basically see there's a little line that goes up to 70, down to 30, that follows the price strength of the stock. So the way that you want to use the RSI is entering the stocks at the closest at the 30 bar and leaving the stock at the closest to the 70 bar. And this basically allows you to secure your profit at the best point. You're basically eliminating your risk of the stock going down, but you're taking away the possibility of the stock going up. And this is how you secure your profit and take the profit most of the time. And so an example would be the stock goes at $10, it's at the 30 bar. It runs up to $20, extremely oversold. That line would be above the 70 indicator. That would be the best point to leave that.
Overbought?
Yes.
Yeah, overbought.
So it would be overbought. It goes from oversold to overbought. 30 is oversold. 70 would be overbought. And and you can use that strategy by going in and entering stocks at 30 and leaving them at 70 and do that consistently over time. And you can lock in your profits consistently.
And obviously almost any online brokerage, TD Ameritrade, Webull, they all offer RSI indicators. They are required to do that, so your brokerage account should allow you to see RSI indicators. If you don't already, find a brokerage that does. But yes, that's a very, very good, solid analytical trading investment. It's also really good if you want to find a good entry point to a stock for the long run. If it's at trading at a 30 and it's been barely going up. It's at 30 for the month, or 32 or 28 on the RSI bar, and you want to hold. It's a good buying opportunity. It really is. In terms of the volume's down for it, and it's been really oversold. And obviously watch out for it if it's above 70 or near 70, because that means it's just really, really overbought. Mm-hmm. Is there any other analytical techniques you want to give them a rundown on they can learn about? Or do you want me to transition to my value investing?
Yeah, maybe we'll save it for another episode. Today we're just focusing on the RSI, the Relative Strength Index. So get that in your repertoire of vocabulary in the stock market, because it's very important to understand, because every stock goes up and down. A stock rarely will go straight up in the air all the way to 1,000, you know?
Yeah.
And that's what we all dream of. But in reality, it comes down, it corrects itself, and then it goes back up.
As long as it has an upward trend over the long run, that's a good buy. But in the short run, it can look like it's going down, but the long run, it goes up. If you look at it, you keep zooming in, there's always troughs, and there's valleys, and then there's the clouds, you know? So that's the biggest takeaway.
Yeah, it's all about, this is for pure active investing. You know, the RSI isn't necessarily something that's that important in the long term, because, you know, as it goes longer, the RSI, you know, is
less relevant.
It's relative to the graph.
Yeah.
It's kind of hard to explain, but, you know,
it's more relative in the short run.
Yeah,
in the
because
long
that's
run,
when the stock is going to fluctuate. If you're an active trader, you are trying to secure a profit. You don't have time to wait that month that it's in a downtrend, you know? Mm-hmm. So you want to get out when it's in its uptrend at the best possible spot.
So the biggest takeaway here is analytical trading is used by all investors at any point in their life, right? If you're looking at a graph, you're using analytics. But the takeaway is activist investors, swing traders, and day traders are the most commonly used traders that use analytical trading. If you are just watching this to get ideas for investing, analytical doesn't really matter. A price of a stock really doesn't matter in the long run if you're looking at companies. And that's what I'm going to teach you about right now with value investing principles. I really want to shout out the book, The Intelligent Investor by Benjamin Graham. It's a really long 600-page read. Some of it is really archaic language, but it's the best value investing book out there. Honestly, that's the one book you need to read if you want to invest in the market and just learn about everything there. It's one book is in it. But for those that haven't read it, I'm going to give you some cool insight to things that you could use. First things first, an indicator called the EPS, earnings per share. It's usually between 0 point negative blah 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 or 1 negative whatever or positive. Earnings per share is how much the stock is earning per how much what the share is actually worth. And I recommend only trading stocks if you're looking to value invest that have a positive or near zero earnings per share. If it's negative, it's having a really tough time being a cash generative business, and that's what you want as a value investor, a cash generative business with a low entry point for a stock price. And the earnings per share is a really good indicator if that stock is earning money relative to what it's trading at. Another one's a PE ratio. It's price per earnings. How much this price is very similar to the earnings per share. PE ratio is a little bit more of a jumble in the short run, but it gives you an idea of how much people are expecting it, what the price is going to be per the earnings. An exceptionally high earnings or exceptionally high PE ratio is very faulty. It means people are paying a lot more than what's actually earning. So a low PE, somewhere in the ballpark, I like to recommend anywhere 15 to 75, a really solid PE ratio. And there's another indicator that's like PE forward or something, FWD, and that gives you an idea of how much analysts are expecting the price per earnings in the future is going to be. But these are good indicators of showing what a stock is trading at and if it's basically valuable. Because you can pay into an entry level for a stock, and the company's legitimately not worth that. And that's all about judgment, and these indicators can help you judge that. But I'm coming at you with the definitions. Future videos, future L&J Financial tips will give you really good insight as to what a good entry level is. We might even bring out some graphs to show you really good examples of what we're talking about. But this is just to get your mind racing. So when you're looking on your Webull, when you're looking at your TD Ameritrade, when you're looking at your brokerage account, looking to buy a stock, you can refer back to this podcast. You can even Google yourself and look at these indicators. So that was the earnings per share and the PE ratio. The last one I want to talk about is the price per book ratio. It's the PB ratio. Now, I recommend anywhere between 1 to 3. It has 1 to 3 on the PB ratio. Anything above that, basically the price of the stock, and it's basically comparing how much the company's market value is worth compared to what it's actually worth in terms of the assets in the company. You don't want to pay for an exceptionally high PB ratio. Super high PB ratio, meaning the market cap and the market value on it, right, is a lot more than what's really worth in the book. And the book is referring to it's an accounting term, but really it's on the quarterly reports and the annual reports, the 10Qs and whatnot. But yes, that's the price per book ratio, and you want to look at companies with good asset to debt ratios. Companies with more asset to debt is the key. Now, if you're swing trading a penny stock, if you're trading some really low cap stock, doesn't really matter what the assets look like as you're trading it on Wednesday and you're buying it on Monday. Doesn't really matter. Long run, you want to have a company with more assets than debt. You really want to go for that because if it has more debt than assets, it's not a cash generative business. But that's really good. I just want to throw that out there. There's a lot more. I can go into this for days. And again, biggest takeaway is make sure it's positive on cash flow. You can look at where the money's coming in. Companies that have money coming into it consistently, positive earnings per share. The PE ratio is pretty low. The PB ratio is between 1 to 3. It's a solid buying opportunity, and if it has really good asset to debt ratio, I mean the assets are bigger than the debt, that's all good indicators that a company's performing well and it's a good time to buy in. But that's my take on value investing. I know I went through super quick. Always refer to us. If you have any questions, reach out to us, and we'll do our best to answer all your questions.
Yeah, and just remember, all these indicators and all this information that we're telling you guys, this is all just to build your criteria for when you think a stock fits you best. So there's no specific PE ratio, there's no specific RSI entry point that fits everything for everyone. It's all about absorbing all the information that you can and doing your research on the stock, and if it fits your criteria for what you want to invest in, then you make an entry point. And all this information is there for you to just look at and make a decision on, do I value this company and do I think that it's going to be profitable in the future?
That's a really good
because
summary.
there's no number that exists that'll be like, this is the company. It's all there's hundreds of different numbers. There's so much information on the debt sheets and everything and earnings reports, and there's all this information that you got to absorb to make your decision and see if that stock fits your criteria to make a play on. And
Julian couldn't have summarized the message better. I mean, it really comes down to if you believe in the company. I like to go with, if from a value investing standpoint, invest in companies that you like, that that you buy their business for, and that you see growing and getting more valuable in the future. If it follows those criteria, I say buy as much as you can while keeping your portfolio diverse, because that's really, really what it all comes down to for anyone listening. But yeah, that covers value investing for today. Julian went into his analytics. We talked about the differences here. And one last thing I want to talk about is having a stomach for investing. What I mean by that is, Julian knows it, I know it. Investing in the market can be very turbulent. You can go the best days, the highs, the $200, $300 days, whatever it is. You can be up 50%, 30%. Then you can be down 30%. You can be down 40%.
Yeah, it's a roller coaster of emotions. So, it's not investing in the market and being an active trader or whatever is not for everyone. And it's all about your confidence and how much of an understanding of the market that you have. And, one thing, I think we mentioned it before, is if you haven't traded before and you're still waiting to take that first, purchase of a stock, start paper trading and start getting comfortable with the market and how money goes in and out of your account in seconds. And and that's, if it's all about your experience and confidence going into the market. Start small and get more comfortable with your money, and you'll see. Next thing you know, you'll be more comfortable putting out that money in that trade because you're confident in your knowledge.
And that's Julian summarizes another terrific point there. That's literally what the mission is. And if you're hesitant on investing your own money right now, out of your own paycheck, out of a gift money, recommend open a paper trading account. Start with like $100,000 because you can put how much money you want in there. Put $100,000. Don't put $2 million. Don't put $10 million in. You're not a hedge fund. Act like this is genuinely. Let's say you got like an inheritance of $100,000, or put $10,000 in. Put an amount of money that you might even predictively put in, and if you're creating positive returns, if you're applying some of the principles that we're talking about here, and on your own research, and you're up 5% every day, 1% every day, you're making consistent gains, then you can have confidence putting real money in and seeing that happen. But investing you have to have a stomach. If you're not for, feeling that loss, feeling that feeling of, oh my gosh, I'm doing great, and today's terrible, it can change in a moment's notice. I recommend just buying and holding and don't look at it. But if you want to be an activist, enterprising investor, such as me and Julian, we're always learning. I'm failing, consistently. I'm succeeding consistently. Our goal is just to make more money than you're losing, and that's really the end of the day.
And just not give up. You could lose a lot of money, and It doesn't take a lot of money to make more money, and it's all about recovering and making the next decision that's going to benefit you. You could you can make a horrible decision. We're all going to be there and make a bad trade, and you're gonna make a mistake. It's all about learning from that and taking it in your next trade and minimizing the mistakes you make in the future, and eventually you become consistent.
Yeah, you're only a failure if you quit. You're not a failure if you make a couple mistakes. If you just learn what you did in the mistakes, why your trade didn't go right, it's no big deal. Brush it off, move on. There's always a better day. You're always going to be 3 feet from goal. You never know what trade is going to take you to the top. You never know what decision is going to take you to the top. So keep going, guys. Keep fucking going. I believe in you. But yeah, that covers this week's pretty short podcast, relatively shorter podcast about analytical and value investing. This has been Lucas for L&J Financial.
It's been Julian. Have a good one, guys. Peace.
Take care, guys.